Okay, before we get into our final lecture of the chapter, we're going to go through the 2 exercises that you did as homework. We started them together yesterday, but let's just continue. I did a little bit of a different format here, which I hope you liked better, but if you did something different, that's fine. So exercise 1-6, if you could find that in the book as we reference all of this. Do you see how the back of the book works? It starts with questions and then brief exercises, and what we'll get into hopefully tomorrow is the problems, so you can go into the homework weekend with homework. So it's asking you on page 37, it looks at all these transactions. Notice there's not a monetary value, but it's just basically looking for the dual effect, like which 2 accounts and where does it impact. We did the first 2 together. The third one says we purchased equipment on account. So you'd see not sure why I can't touch. Sorry. You see equipment go up, but we didn't buy it with cash. You see AP go up as well because we owe now on that equipment. I'm going to say over here, I don't have a book in front of me. I'll just wing it. Number 4, it looks like we sold stuff. I shouldn't say stuff. We sold services. So you see owner's equity go up because revenue is going up. Did these customers pay us in cash, though? Okay, what do we own? Why is an account receivable something we own? We own what? Yeah, what they charge us, we own the right to eventually getting paid. What's eventually going to happen to AR? That asset's going to go down, but being replaced with what asset going up? When someone pays us a bill that they owe. Gosh, you guys got it. You're starting to get it. I love it. In number 5, it looks like the owner withdrew money out of the business. So you see cash go down and you see owner's equity go down in the form of drawings. Should the owner be doing that? Sure, he's the owner. Okay, if he has the funds to do it, by all means. Number 6, referencing back what happened in number 4. We see AR go down because they paid their bill. Because we don't have dollar amounts, we don't know if they paid all of their bill, but that's always a good one. When a bill goes down, whether it's an AP or an AR, that means we're paying off a debt or we're getting a debt paid off to us. Number 7, we see, without me looking at the book, it looks like we bought some advertising. Is that true? Okay, so you see overall worth go down because an expense happened. Did we pay cash for that though? No, we charged it, which is an AP that we owe, hence the liability. Remember, anything liability-based is what we owe. Number 8, we bought equipment. We see an asset go up, but we paid cash for it. Good for us. Let's not add anything more to that owe list or a liability list. And finally, number 9, we got cash because we sold something, making revenue go up again. Was there only 9 of them? Okay. Tell me the difference between, I see revenue here. What's going on? Is it not? Oh man, my smartboard doesn't seem to be working nicely. Tell me the difference between revenue in number 4 and revenue in number 9. We're getting revenue. Our overall worth is going up, but tell me how we're making money off that. In number 4, it's easy. They paid cash. In number 9. In number 4, it's a little bit of a waiting game. What are we waiting for there? For them to pay the bill. Okay. What questions can I answer? Is it starting to click? Sometimes it's kind of nice to get rid of the numbers and just talk generally. Okay, that's what I liked about this exercise. Exercise 7 looked like this. This is how the answer key wanted us to do exercise 6. I liked our version better. Exercise 7. Oh boy. That was not anything like what I thought. Did you guys do it more the T account version? Yeah. Okay. Boy, that's a weird one. I didn't even see that, A, B, C, D, E, F, G. So if you look at number 1, purchased computers on account, I don't know, do you guys want to just look at the letters or do you want me to walk through it? What would you like? Walk through it? Apparently, I have to restart this thing because it's not letting me write. So I'm going to hit pause on my recording. Well, let me touch my, maybe it got unplugged. Today we are going to focus on that the financial statements are very much the communication side of the I, the R, and the C. We identify, we record, and now we tell the money story to both our internal and external users. We do this through 4 financial statements. Again, we tell our money story, or we communicate that money story, the I, the R, the C of communicate, through 4 financial statements. The statement of cash flows, I want you to know the vocabulary that goes with it, but know that in the 12 chapters that we do, you're really not going to do many statement of cash flows. It's more knowing that they exist, knowing that the vocabulary to be able to explain what it does, but we're not actually going to put it into practice. These 3, however, we will put into practice. Income statements and owner's equities span over time. They look at how the business did in 2016 or 2017. They span over the fiscal period. A balance sheet, however, is a snapshot in time. Right now, how much cash do we have? Right now, how many people owe us money? Right now, who do we owe money to? And it changes by the day, really. These 2 are needed for one tiny portion, or forced math, like I like to call it, on the balance sheet. So let's start taking a closer look at each of them. A balance sheet, as I mentioned, is a snapshot in time of the company's financial condition sucked out at any given day or hour. Jeannie Monum was just in my personal finance class last hour, and she showed us the balance sheet. She showed us right now how much money our school district has. Will it change maybe even later today as she writes a check or gets a check? Absolutely. So it fluctuates, and it's just like you take a little syringe and suck out what is the financial health or stability of our company today. Here is what it looks like. It's aloe, vertically. You see a heading that says assets. It lists each of them and then says total assets. It's got a heading that says liabilities and owner's equity, listing each of them, totaling them, and lo and behold, the numbers equal because of aloe. It's this same assets equal liabilities plus owner's equity, just vertically stacked instead of spread across horizontally. You've been doing balance sheets the last few days and you didn't even know it. If I go back a couple steps, this is a balance sheet, you guys. It's just the accountant's version of it. Is this easy to communicate our story? Not really. It's kind of a mess. But then remember how at the end we added everything up? Remember this? 18,050 equals 18,050. Well, then the C part of all of this, we communicate that same thing in a much more visually appealing professional format. That is the same thing we did with that transaction analysis. It just looks nicer. Would you agree? how this owner's capital number is in red? Do you see that down there on your balance sheet? If you have to highlight it, if you have to circle it, do something. And I want you to put a notation that says that is forced math there. That is forced math. Based on the expanded accounting equation. I'm going to go back to that page from your notes. And I'm going to ring just the owner's equity section, specifically the 4 totals. Did we have 2 things that made that owner's capital go up? And did we have 2 things that made it go down? We had a plus 15,000, we had a minus 1,300, we had a plus 4,700, and we had a minus 1,950. That forced math is what got us 16,450. So that number is the plus investments, the minus drawings, the plus revenue, and the minus expenses. From the expanded accounting equation, that is the one number that we simply call owner's capital. Hiding in there are all the pluses and the minuses. Let's move on to an income statement. It's about time the book says this is really how this looks, because so far they've been hiding it all in owner's equity. An income statement simply takes a look at revenue, or money in, and expenses, or money out. We know that those have been kind of hiding in owner's equity right now, but we really should know that they belong on the income statement. A few things that I'd like you to note: when revenue is greater than expenses, we're happy, because that is what's called a net income. If you make more money than you spend, you have a net income. Do you think net losses ever occur? They do. And that is when revenue is less than expenses. So you made money, but you had way more bills. Some terms out there. When you have a net income, it's said to be that your numbers are in the black. When you have a net loss, it's said that your numbers are in the red. Have you heard those terms before? It's how Black Friday shopping the day after Thanksgiving got its name. It's such a big shopping day that they named it Black Friday, because the stores were selling or generating so much revenue that it could beat their expenses. That's how Black Friday got its name. Do you think some stores experience Red Fridays, where they're paying more of an expenses than what they're selling? It's why store owners in small towns end up having to close their doors. They just cannot get into the black month after month, year after year, which is sad. An owner's equity statement then reports things like pluses and minuses. So changes in owner's equity. Finally, you get to see it full circle here. You first start with an income statement. You take a look at your revenues minus your expenses to hopefully equal a net income. An owner's equity statement is simply the expanded accounting equation in a nice format. The accounting equation. Because it says, okay, what did the owners start with? What was their beginning capital? Plus and plus, minus and minus, to see what they're worth at the end. Now stop a minute. I thought owner's equity, there were 2 pluses and 2 minuses. That's what the book started showing us, didn't they? But we now know net income has 2 of them hiding inside of it. Net income is hiding revenue and expenses. So we're not really even going to deal with them because we figured that out in our income statement. And we can tuck that net income, which really is a plus and a minus inside of it, isn't it? So we knew that owner's equity had 2 pluses and 2 minuses, but we wipe out a plus, we wipe out a minus by figuring out our net income. We wipe out our plus revenue, we wipe out our minus expenses. Question? If you have a net loss, then you, instead of adding it to their worth, you would subtract it from their worth. Really, really good question. If it would show up as a net loss, it would be with the less drawings. I'm going to be honest, the book rarely makes you deal with net losses. Do you still see the other 2 plus and minuses? There's one of the pluses, there's one of the minuses, but we see the old plus and the old minus hanging right there. And then remember, this is your forced math number based on the owner's equity story, or the second thing that we did. So do you see why we should start with income statement, then build an owner's equity statement, and then build our balance sheet? Because of that forced math. We're forcing the math here as we go. Let me backtrack again. These 4 numbers, the pluses and the minuses, are used to build right here. Here was one of the pluses. Here was one of the minuses that we now know has a new name, net income. Here was one of the pluses. Here was one of the minuses. So these guys were the expanded accounting equation that we're cinching together to bring to that one forced math number down there. And it's owner's equity. And really the only thing we're concerned with is we're calling all of that legwork owner's capital down there. If I've lost some of you, it's time to put this into practice with real numbers, and I think it's going to start to click. You've read it once, I bet you were lost. You've heard it from me now a few times. I still might have a few of you lost. I think when we start doing all of this, it's going to start to click. Should we try it? One thing I'm not going to make you do, we'll come back to cash flow in a minute. One thing I'm not going to make you do is homework tonight by yourself. We're going to do as much as we can together in class. Because this is so new, because I'm seeing deer in the headlights from some of you, then we're just going to pause and pick up right where we left off tomorrow. Sound like a good idea? Okay. Remember, there's 4 financial statements. The 3 that you just got done marking up with me are the 3 biggies that we'll do. Cash flow statements are very important. It's just that you're not going to ever have to do one for this class. It's just more knowing what they are. It's basically, where did our cash come from? What did we use it for? And how did that affect our cash balance? It's just looking at cash. Focusing on cash that came in, focusing that cash that came out. Basically a bank statement. Money in, money out. Just pertaining to cash. What I'd like to do is one exercise here. And if I recall, the exercise says, let's start with an income statement, build the owner's equity statement, and then from there, force the math to get our ALO all working out. Whatever we don't finish today, we are going to pick right up where we left off tomorrow. So our focal point is exercise 1-9, which you find at the very bottom of page 37 and goes over to page, wait a minute. Oh, it is page 37. You should see this in your workbook. I hope it's in your workbook, goodness. Find exercise 1-9 in your workbook. Is it a page? I hope it is. Is it multiple pages? Is it all in one? Yeah. Yay, it's on page 6. Fabulous. Okay. I'm going to pause, but will you please tell me to hit record again? Okay, right. All right, together we are going to do exercise 1-9. If we don't finish, I will pick up right where we left off tomorrow. Exercise 1-9. We are going to build 3 financial statements. Remember, how many are there? 4. That cash flows, I just want you to know that it's money in, money out pertaining just to cash. Okay. We're going to build the 3. And you're going to see how those transactions are messy. That's the R. That's the recording. That's the doing. And if we'd hand that to, say, an investor, they'd probably go, what a mess. You take it one step further now to build these 3 financial statements that look a lot more presentable, and they're a lot more simple to read. Okay. One thing that I forget if the book talks about it or doesn't talk about it, put it somewhere, whether it's in your little side margin of your workbook or it's in your notes. Anytime you do financial statements, points on the test, proper accounting tells you you need to have use of what are called rulings. Okay? You get to your total number, a number, okay? A single line above your final number and a double line below. Old school accounting teachers would make you get a ruler out and use a ruler to do your rulings. I won't make you do that. It's why Microsoft Excel has a little border button with a single rule and a double rule below it. What does the single rule mean? That simply means there's math above there. There's a math above that line that has brought us to this number. The double rule means our math is complete. It's kind of like stamping the, we're done with this number. So a single rule means there's math above to get us to this number. The double rule means we're done with the math. Voila, here's our number. And I do have to take points off on the test if you don't do your rulings. We are going to begin by building our income statement, but not before I remind you the order. The order that we're going to use to complete financial statements is this. We are first going to complete our income statement. We are second going to complete our owner's equity statement. Finally, we'll complete our balance sheet, which is simply ALO done vertically. Knowing that owner's capital is forced math from here and here. That, my friends, will be a driving force. If you're going to memorize something, memorize that because you're going to do it in this order. Ending with balance sheet, which is simply ALO, When you get to the owner's equity, you will have one account called owner's capital that's forced math from doing the other two. That's why we go in that order. Let's start with the income statement. Where are we getting our numbers for this? From that little thing in the book. I don't have anything up here to look at. Other than what's in your book on page 37. Let's total our columns. I think some of you had numbers in there from your previous classmates. Cash, as we looked through 1 through 10, went up, went down, went down, went up, went down, went down, went down, went up, went down, ending at a 8,350. Is that what most of you had written in there? If you didn't, please add that. AR, we own the right to getting paid from these people. It started at $3,900. They only paid $450 of their bill. So AR, we still own the right to getting paid $3,450. Supplies is pretty easy. Equipment is pretty easy. They each have their balances there. We cross over to the other side of the giant aloe T. We look at accounts payable. It's stuff that we owe money on. We owe $2,000. Owner's capital is sitting at $15,000. Owner's drawing minus $2,000. Maybe put little OEs under those numbers because they're going to be on the owner's equity statement. Revenue was $8,500. Expenses, I can't do the math in my head. I don't have the number. What do you guys have? Yeah, that's right. 5950. Revenue and expenses show up on the income statement. Put little IS's next to those. 5950. Revenues are 8500. Expenses are 5950. Out of the pluses and minuses now, plus capital minus drawing, that pertains to owner's equity. Plus revenue minus expenses, that pertains to the income statement. All of which is going to be hidden on the balance sheet. Here we go. Are your lines numbered? Yes, they are. That's great. Line 1. I'd like you to write the word revenue. On line 3, I'd like you to write the word expenses. I'd like you with a highlighter to highlight what you just did. I get this to go away. Whatever. Those are headings. You're going to have multiple things popping under each heading. Okay? We're going to get deeper into the chapter and know there's many types of revenue. But right now, simply put service revenue on line 2 and notice it got indented. Would you have to indent? No. You know, if you were in Excel, you'd maybe put the word revenue in a different color or it would be bold. That's why I wanted you to highlight it so you could see it's more of a heading. Kick the actual account, service revenue, in a little bit. Holy moly, there's 2 columns. I'm going to just pop ahead. Typically, the further left you go, it's more itemized. The further right you go is more of a total. The reason you're seeing 8,500 over there in the right column is that there's only one. It's kind of like a total. So the further right you go, it ends up being more of like math in and of itself. As you get further left, it's more of the itemize before you total. So do you see how that looks? How do we know it's called service revenue? How do we know that? It says revenue up here. Well, I assume it, let's see. It doesn't ever really say, but let's just go with service revenue. You might say, oh, I don't like that, Mars. I want the honest answer, but I don't see where it says. Just put service revenue for now. We don't have any other service revenue. That was it. We totaled it. That was it. What if we would have made money a couple different times? We would have taken the full total. Like let's say later in the month we would have gotten another $1,000. We'd be putting $9,500 right there. You're just taking the totals. Okay. On line 3, we've said expenses. Notice nothing is going, and don't do this in your notes, but look at nothing is going here. These, what we've highlighted are more headings. How many times did we pay expenses? 3. Do you see above where it says the expenses were $650 for rent, $4,800 for salaries, $500 for utilities? And so that's where you can go ahead and list them as what they are. Salaries and wages expense, rent expense, utilities expense. The reason we've shoved them over in the left is because it's like we're trying to get to more of a finalized number. Sometimes students will say, does it matter what order I put those in? There's only 8 of you. If I had 30 people and I'm trying to grade 30 tests, yeah, it'd start to drive me nuts. Some businesses will put them in alphabetical order. Some businesses will put them in order of the most money. Which route did this go? The most money, okay? Is there a right or wrong way to do it? No, it's kind of up to the business. Now, I see my first single rule. Because we've got some math to do. On the next line, so we've done 4, 5, 6, 7. You'll notice the book even indents that further. I'm okay with it being lined up with your items. That's fine. Total expenses. What does the single rule mean? Math above. Why do you think we kicked the 5,950 over to the right? It's more of a finalized math number. I see another single rule. Why? Because there's math above. Tell me, do we have a net income or a net loss?
Good morning. The 8th graders will be returning to their third period class. All 8th graders will be reporting to their third period class.
Jenna's absolutely right, because we have a larger revenue than we have expenses. I don't know if I should have wrote it there. I'll put it up here. Our revenue was $8,500. Money in. That was greater than our expense total of 5,950, which we know is going to be a net income. We made more than we spent. The reason we put a line there is because we have to take 8,500 minus, I'd like you to put a minus in front of that 5,950. To be net income, and I don't like how the book did this, I want you to put your 2,550 out here instead. I didn't like how they put that there. It kind of goes against what I've been telling you. Math is for the far left columns. Totals are more of the far right columns. The reason we said net income is because our revenue is greater than our expenses. I put 2 lines under 2550. Tell me why. I'm done with my math. Question. When OE had 2 pluses and 2 minuses, have we wiped out one of each already? We've wiped out revenue. We've wiped out expenses, leaving the owner's equity statement with any investments that they made or any drawing that they made. But we're going to kind of bundle what we just did, we know, into a plus. This is a good stopping point. Are we going to use any of these numbers tomorrow? We absolutely are. We know we've got an investment and a drawing to take care of. Slap a little net income in there, and then we'll be able to create a balance sheet from it.